Hi, I'm Mary Lyons, the Wealth Woman.
I'm Eric Alexander with Benchmark Income Group.
Welcome to the Big Wealth Podcast. Today is part 3 in our Myths About Insurance series. There you go. I don't know why I'm having a triumvirate was where I was going to go. And I'm like, I don't think that actually fits here at all, actually.
You just wanted to use
except
a big
that
word.
I did. Thank you for letting me get that out. Yeah. I feel good. It's probably the only one I'll use all series. So we're just going to continue on. We've talked a little bit about insurance as a product. We've talked about some of the myths around insurance as an investment. And as we said last time, it's not an investment. So there were plenty of those. It's actually a savings tool. And the big difference between those two is just investments have the possibility of loss, and long-term insurance has some guarantees associated with it. And so it's classified as a savings vehicle, which is why you do not have to have an investment license in order to provide that as a tool. So today we are actually going to talk about insurance as a strategy and really break down some of the myths around how to use insurance strategically. So Eric, kick us off.
Yeah, so these are going to be a lot of fun because I think this gets into the nuance of kind of what we do for people and this idea of economics-based planning and where it really starts to come to where it kind of flourishes. So I'm gonna jump right into the deep end on this one, and we touched on this topic a little bit in the first episode of this 3-part episode or this 3-part series, but whole life is a great way to buy expensive stuff. Is one of my favorite conversations. And again, yes, maybe not. It just depends. So kick us off. And I think a little bit of this is really that IBC conversation.
Yeah. So IBC stands for Infinite Banking Concept. It is a super frequently Googled term when it comes to life insurance. But this is a concept that says if you fund a whole life insurance policy for liquidity, that you can then borrow from the insurance company. To be very clear, people get this wrong all the time, but the truth of the concept is that you borrow from the insurance company while leaving your assets continuing to grow on the compound growth curve at the insurance company. And the reason that part of the reason that people like to do this is that they have uninterrupted compounding on their asset.
Which is good.
Do what?
Which is good.
Which is
all
great,
positive,
right?
Yeah.
And even if you have to pay the insurance company interest, if you are making payments and paying down your loan, typically the amount of interest that you would pay to the insurance company should be less than what you're earning if you use a particular contract that is non-direct recognition. So I'm just going to throw that in there to make sure that we are being technically accurate with everything that we are saying.
Right.
And the reason that people like to do this is that when you borrow from an insurance company, most insurance companies offer an unstructured loan. So they will pre-charge you the interest for the year upfront when you take the loan. And then if you are making payments, they will refund you the interest that you no longer owe. But the beauty is you can choose to make no payments, or you can make payments monthly, or you can just put money towards the loan when you have it and don't worry about it when you don't. And there are different consequences for making those choices, but you have all the same cash flow freedom that you would have using cash, except if you've got cash in your checking account, chances are it's not earning very much. And then when you use it, it's not earning anything other than wherever you put it. And if you use this particular concept frequently, you can retain the earning on your capital. And then just like you would replenish your savings account to make the next purchase, you repay the loan to the insurance company on your terms in terms of how you put it back. And then once you have paid down the loan or eliminated it altogether, you can repeat the process. And so you can do all of this without interrupting the compounding on your money. And frequently the money is compounding at a much higher rate than you could get in a traditional checking or savings account, and sometimes even CDs. So that in a nutshell is the concept of infinite banking. I have way oversimplified it. We are going to do a deep dive into this concept here shortly. But I frequently have used this in order to buy expensive things. But then there have been times where I have very strategically chosen not to.
Right. Yeah. And that's a great point. I remember, so this concept is what initially got me into the industry. It was come for the sizzle, stay for the steak. I think it was kind of how I got introduced to it, but it was like, wow, this is fascinating. I never knew this was possible, blah, blah, blah. And then it was like, wow, this is just one part of a much broader system of what we should be doing, right?
Right.
That's the staying for the stake. But one of the questions that we always got at the very beginning of this was, okay, so if I'm going to go buy a car, every single time I want to go buy a car, I should borrow money from my insurance contract. I'm like, no. If Toyota Financial or Honda Financial or wherever you're going to go buy a car is giving you 0% money or 1% money, go take their money. Because if the insurance company is going to charge you 5.25 or whatever the number is, then if you're going to pay
Why would you pay interest that you don't need to pay?
Yeah, go get someone else's money that's cheaper. But when it comes to this idea of mindset, strategy, tools, from a strategy standpoint, I want flexibility. That's one of the primary needs that I've got for all of my planning is if for some reason Toyota comes back and says, hey, yeah, we were doing that 0% deal, but now we're not doing it. Now it's going to be 10% for the car loan. Well, now I've got choices. I've got places that I can go and I can go pivot.
And now you're going to go take the loan at 5.25 from the insurance company because it's less.
Right.
The concept, the truth of the concept, if we boil it down to its absolute basics, it's get your cash compounding,
right,
even if you intend to use capital, right? And then if the insurance company has either the most flexible loan rates, which maybe you need,
right,
or they have the lowest interest rate available to you, use that. And I'll tell you, I actually really like this as a strategy because we assign zero value to our cash. So I'll use an example. If I decide I'm going to go pay cash for something, I take it out of my account, I pay cash for it. I don't really feel any pressure to rebuild my account as long as I have a certain amount of cushion. Right. But if I borrow from the insurance company, even though I have no real pressure, right, I can just use my cash value against it, surrender the loan, be done. I still, because I have a loan and I am a normal human being and I am debt averse and I want to pay it off, I actually get a lot more aggressive with my saving than I would if I was just putting money back into a savings account. And so for me, at least, there are some mental aspects of borrowing from the insurance company that I really like. But I think your example of the car was perfect because I do remember having a conversation with the client, and the client was like, wait a minute. I thought I should borrow from my insurance company. Well, when I bought my last car, I could get 1.99 financing at the dealership. So I just said, okay, I think that's a better deal than borrowing from my insurance contract at 4.76 was the rate. I mean, there's a huge spread right there. I'd rather pay the 2%, but then I'm keeping compounding on all my money. And it made a difference of thousands of dollars of retained earnings, money that I got to keep growing versus had I paid cash for the car. Even if I paid myself back with the same 2% interest, I wouldn't have had as much money as I ended up with in my account because I kept the compounding. And there's a lot more to that concept.
Yeah, it's very deep.
I think at the basis, it depends on if you can get capital somewhere else cheaper. Yeah. Right. And then the second piece of this, when it comes to acquiring expensive stuff, acquisition strategy has a huge impact on long-term profitability.
Yep.
And I think sometimes we just default to whatever we think is going to be the easiest way to acquire something or the least headachy way, the least hassle. And sometimes it makes sense to look much, much deeper into this because how I might acquire a vehicle, an investment vehicle that's maybe debt-based, where the tax treatment is ordinary income tax on my returns versus how I might acquire something that gives me capital gains treatment. I might choose to do those differently. I might choose to do one of them from an insurance contract, and I might choose to do the other from a self-directed Roth IRA, right? Just to make sure I'm getting all the best benefits. But those are the kind of things that you have to run the math each and every time to make sure that the decision you're making is the best decision. And this goes back to me, if I were looking for an advisor, because I didn't have access to everything that we do in-house, one of the things that I would want is an advisor that I could call, not just about how my investments are performing, but about any decision I'm making with my money. And I'd want to say, okay, can you show me if I do it this way, what's my outcome versus if I do it this way, what's my outcome? And how does that change things for this individual decision. But when you plug that math into my long-term financial decision, how does that impact what I get to spend in retirement? And that may seem like a lot of extra work when you're just trying to figure out how you should finance or buy a car. But it should also be happening if you're buying real estate, if you're making a private equity investment, whatever it may be, because all of that acquisition strategy is going to have a huge impact on your long-term ability to build wealth and create income.
Yeah. And it goes back to that original point of what we call EVA, or economic value add, is if you give every single dollar in your system a job, then before you go deploy it, you have to make sure that it's performing, it's doing its job. Right. And if you're just deploying it with no thought process, you've got, you're wasting money. You've got to bleed in your system.
You're letting money leave you.
Right. But to your point, every time I have to go borrow against my policy, it requires me to think through it. It's like, okay, do I really is this how I want to go deploy that capital? What's my rate of return? Is that bigger than what I could go get somewhere else? There's a thought process that is much deeper that happens in that moment that doesn't happen when I'm going to go buy shoes or clothes or a Maserati or whatever, right? And I think the IBC component of it, that it always sort of annoys me, and it goes back to a stupid joke, and then we'll drive on. But I remember this old joke from when we were younger, and this guy walks into his house and he's like dripping with sweat and he's huffing and puffing, and his wife is like, what happened? What's going on? Why are you like sweating profusely? He's like, well, we were trying to save money. And so I thought, instead of taking the bus, I would just run behind the bus as a way to go save money. She's like, well, you're doing it wrong. You should have ran behind a taxi cab. They're way more expensive. And so it reminds me of this idea of, some of the TikTokers and Instagram people. All I got to do is buy really, really expensive cars, and that's my way to go win in life.
No. You
can't spend your way into wealth.
Right.
And that's one of the things.
Can you say that again?
You can't spend your way into wealth. And I think that's a big component of where sometimes the strategy becomes the solution. And it's not the end. It's just a means to get to the end.
Yeah, I remember one time, and I think this goes to this whole idea anyways. I can remember sitting in a class where they were saying, okay, if you buy the car this way versus if you buy the car this way. And they said, see, so if you buy the car this way, this is your profit. And I was like, there was no profit. There was no profit because you bought a car. The difference was you kept some earnings, right, in the first scenario, but there was no profit. You can't go buy 10 cars and magically create money. That's not, unless you're selling them because you're a car dealership, in which case you probably can buy 10 cars, sell them, and make money. Right. But if you were just buying a car to drive, you're buying a depreciating asset, and you may be minimizing the expense of buying that car. Right.
You can make it less painful.
But you're not creating a profit by buying it. And that's where I think it goes back to, right, there's an element of truth in some of these myths.
Yep.
But sometimes the positioning is really misguided.
Yep, exactly. All right. One of the other ones I love, we don't say put all your money into whole life, and this should be 5 seconds. No. Again, I think the industry is divided, and it's a natural division. If you're an investment person, you think all I got to do is buy more mutual funds or ETFs. If you're an insurance person, the natural inclination is, I don't know what problem you have, but you need to buy insurance. But the reality is that there's a balance in the middle, and there's power in having the combination, not the extremes.
Yeah, I think the argument here is, if it was such a good asset, they should be telling you to put all your money into it. Oh. And I think that's ridiculous. Nobody says put all of your money into real estate. Nobody says put all of your money into the stock market. Nobody says buy one stock and put all of your money into it. Right. And if they are saying those things, that actually is a red flag. This is about true diversification and about having all of the tools in your box that you actually need to be successful.
Yep.
So if someone does tell you put it all in this bucket, red flag. And if someone says you shouldn't put all of your money in this bucket, right? Kudos, you shouldn't. It's about the combination. I'm going to use a really ridiculous analogy here, right? We're going to talk about commercial grade epoxy. So commercial super glue. It comes in 2 tubes, resin, hardening agent. If you forget either one of the tubes or you have the materials in the wrong ratio, it does not function. But when you have both of the materials in the right ratio and you put them together and you mix it, it creates a bond that can frequently hold up to 2,000 pounds. The magic is not one or the other. It's
Right.
in how they're interacting with each other. So of course you should not put all of your money into a whole life insurance policy. I
Right.
don't see any reason that I would personally ever do that.
Yeah. Yeah. And again, it's the extremes. All right. So another extreme, another one that's a favorite conversation of mine is whole life is a great way to pay for college. Yes. And
No,
yes
it
and no.
depends.
It
It depends.
depends. And I hate it because I feel like I need to just say depends as I hit my ears on my shoulders as I say that every time. But I don't know, maybe. But yes, it could be. And there's a lot of reasons why it could be, but then there's also some downsides to using insurance to pay for college. There's some instances where I think it doesn't work. And so I'm going to walk through a couple.
Sure.
If insurance takes a little bit to get going, there's some costs in the upfront and you got to get some spin up. If you're 6 months old, 3 months old, 2 weeks old, and you're going to start some of this to go help pay for college, you got some time. You can make that thing sing. If you're 14, if you're 16 years old, probably not a good solution. You don't have enough time to overcome some of the upfront costs. There's all sorts of issues on that other end of it. So
it doesn't mean it doesn't fit. It means for this specific purpose, it may not be the best tool.
Right, exactly.
And I think some of this is even bigger. So we have a whole episode on how to use life insurance to pay for college.
Right.
But when I think about what I'm actually doing with my kids, it's funding the insurance contract. And to your point, I started the policies when they were 15 days old, right? As soon as they were eligible for it, I had them in it. But I did it as much for the long-term changes that it made to the overall plan and the generational impacts that it makes to the overall plan as I did for the college funding. And I actually chose it for a couple of reasons. I don't like anyone telling me how I can spend my money. Ask my husband, he'll verify that for you, right? But the reality is I don't want to be in a position where if I choose to use the money for something other than college, I pay penalties. And that is a personal preference for me. Other people may not have that same response to that, but I also know that what I'm building is a system. And so if I look at one bucket, one purpose, life insurance is not the best place to put money for a college education because you can get a higher rate of return somewhere else.
Right.
But I don't look at money as one bucket, one purpose. I look at money as a dynamic system. And I totally am stealing all of your language and taking all the credit for it when I say that, Eric, but we all know you're the genius behind this. I'm just a pretty face. And so when we look at how this is actually working, to me, it's about funding it somewhere that has steady and predictable growth, that I'm not going to be in a position where the market takes a major loss right before my kid goes to college and I lose 25% of their college funds. I don't want to pay for 3 years. I want to pay for all 4. Yep. And so when I look at what we're doing, it's building a pool of liquidity. And then I am using that pool of liquidity with my children so that they are learning with their own money to go and make other investments that produce income for them and to build enough of those that by the time they go to college, that income is actually going to pay for college tuition and living expenses. Because what I want for my children is the ability for them to have the asset in the whole life bucket, equity, if we're doing real estate, the income that comes from having real estate and a college degree, all without ever interrupting the compounding. Because if you look at a compound growth curve, the best growth is at the back, right? Versus if I do it with a more traditional method, like a 529, I may get to put less money in and it may grow at a faster rate of return. But at the end of the day, all the money's out of the account. My kid has a college degree, but the money itself is gone. And so they're starting over in their adulthood and lopping off the first 20 years, well, really the last 20 years of what could have been compounding for them. And so sometimes it makes sense to do something else because you just want an easy button and you don't want to think about it and you want it to happen on autopilot. But if we're really putting it in the context of how do I build wealth, I think it's a nice tool. But again, right? You got to put your own oxygen mask on first. And sometimes you might need to do one bucket, one purpose, because that's the only way you can reach the goal that you have set aside for what you're trying to accomplish.
Yeah, and well, and that's the biggest challenge that I've got with it is there's becomes an almost ethical or moral conversation in the middle of it of I only have X dollars to save, and mom and dad paid for college or blah blah blah, whatever story they have it in their background, or they didn't, and I came out of school with debt, and I don't want to pass that on to my kids, so I'm going to go do this thing, and I'm like, great, that is a noble thing to go pay for your kids' education, but you're going to be homeless. Like if that money doesn't go into your system first to make sure that you're not a burden, you're going to go do this great thing. You're going to set your kids up for this education. And then you're going to be a burden on them. So you better hope that they're making buku money on the way out. Otherwise you're now a drain on them. And so I think that sometimes which way should I go? You got to put the oxygen mask on you first before your kid. Right. And sometimes that's an emotional conversation. But then when you start to go, okay, well, I've got a couple extra bucks to throw there. Where do I want to go put it? And a lot of times what we have is people that don't want one or the other, they want the and. And so they'll do an investment account or 529 or something market-based and insurance.
Right.
And then they feel like they're kind of threading the needle between the two. And I think that's a great idea because it fits where they are and it gives them that and solution on the other side.
I want to flesh out something that you said here just a minute ago, and this is a little bit of a tangent, but I do think it's important to make sure we're giving clarity on this piece too. So when Eric talked about making sure that you are putting money away so that your retirement is taken care of and you don't end up a burden on your kids, I just want for a minute, right? Because there were probably some people that had a strong emotional response to, no, I really want to do this for my children.
Right.
We are not advocating that you don't fund your college education for your kids.
Oh, for
right?
sure.
That is not what he said. So I just want to make sure we're clarifying that. I think the point is, because we've had this conversation before, I don't remember if we've done it on the show or not, but the idea here, when we say put your oxygen mask on first, is that if you have the ability to fund your own retirement and do it in such a way that you can leave potentially millions of dollars to your kids, generally right at the time they're getting ready to retire, if they had to pay for student loans, but they receive a multi-million-dollar inheritance, I don't think they're going to hate you for that. Right. Versus if you pay for their college and and then they end up paying for your retirement and your long-term care and that sort of stuff, and there is no inheritance, there may be more resentment that comes from that. And you haven't really accomplished what you wanted to accomplish, which is setting up your children for long-term success. Because let's face it, that's what we all want as parents is long-term success for our children. And sometimes when you view things through a slightly different lens, you have the ability to do more. Sometimes when you learn the things you need to do to put your own oxygen mask on and make sure that you're building wealth and that you're setting up the next generation, you actually can surprise yourself and get to the point where you could also pay for their college education a lot more quickly.
Right.
And if you just put money for college education and don't take care of your part. And so it's not, again, it's not an either or kind of decision. I just wanted to touch on that just a little bit because you hit on that really, really fast. And I just wanted to make sure there wasn't any confusion there, right? All of this is about making sure that you take care of yourself and take care of your kids, not one or the other.
Yeah, exactly. And my point on a lot of that is,
and I know that's your heart. I just wanted to make sure like all that was clear for someone listening.
I've just seen so many people, they've got $5 to rub together for investments. And they're like, I think I'm going to send $4 to my kids and $1 to my future. I'm like, yeah, let's rethink that. Right. All right. So you need whole life for estate planning is one of the other myths that I think is always a fun one. And we actually dealt with this a couple of weeks ago, and it was a really fun conversation. But a lot of times when you start getting into estate planning problems, meaning your estate is big money, right? And you're worried about passing it on, there becomes a lot of other things that kind of get pulled into that argument that for the vast majority of the public, it's not a problem that we got to go deal with.
Right.
So talk a little bit about sort of where whole life fits with estate planning versus some of the other tools.
Well, I think understanding like when does it make sense, right? Right now, if you were to die this year, you don't have an estate planning issue unless if you're married, like if both you and your spouse passed away. I think the exclusion is what, 12.9, somewhere in there, 12.9 million each. So for most people, if you're under the $24 million threshold, $25 million threshold, you really don't need to worry about estate planning for the next 2 years. However, the exclusion drops to 6 million here in a couple of years, unless they revise it again, which who the heck knows, it gets revised all the time. So then that drops down to, okay, if when you die, there's more than, call it $12 million at that point, then you have an estate tax issue. And so I think right now, and don't quote me on this because I didn't look it up right before this, and I'm a big believer. Einstein said, don't remember anything you can look up. So you guys Google it and correct me if I'm wrong. When you think about the estate tax, right, anything that you have above that exclusion, so call it $12 million after 2025, is going to be taxable. And I believe it's taxable at above 40%.
Right. Yeah. It's fairly heavily taxed.
Yeah. And at different points in time, it's been different amounts. It's been as high as 55%, I think, at different points in history, maybe even higher than that. And
the exclusion keeps changing too. Like how much is excluded before it gets there is a big number.
Right. So a lot of times advisors will recommend that you have permanent death benefit of some sort that will show up when the second parent passes away to pay the taxes specifically, especially if the estate itself is not particularly liquid. So examples of that could be a bunch of real estate that
farms
can't be sold easily. Yeah, farms, or it could even be there's a big business, right? And if you had to suck all that money to pay taxes out of the business, it might collapse the business. So there's some reasons to use permanent insurance of different types, but in this case, we're talking about whole life for estate planning purposes. So some of the argument I think here against it is that there may be cheaper ways to acquire permanent death benefit
for that one use.
Yeah. So sometimes we see second to die universal life insurance contracts used for this purpose, especially if they have a secondary guarantee, because even if the cash value gets eaten up over a retirement lifetime because of fees or non-performance or something like that, the death benefit stay in place. But there's some dangers to that too, because if you ever miss a payment or, you know, if you don't read the fine print in the contract, there can be some issues. So whole life insurance definitely could make sense, but there are some unique and different ways to do that. There are a couple of different policies on the market that have something called a survivor purchase option, where you can the money includable in your estate and you can access it. And, you know, if you need to get your hands on it, you can get your hands on the money and you have choices and flexibility. But then when the first person passes away, the second person can disclaim part or all of the death benefit, have it go into an irrevocable life insurance trust, buy more insurance, and then that's there on the second death. And I know that was like bam, 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 right through there. But the reality is that there are creative ways to look at estate planning. And most people don't have an estate issue. And I have definitely seen situations where people who are high earners when they're young, but they might also be high spenders, put money into an irrevocable life insurance trust and pay big premiums into some type of permanent life insurance. And then when they get older, they don't have the means to continue paying, or something happened and they lost a bunch of money and they don't have the ability to access all that money they built up because they gave it irrevocably to their children. And especially if the relationships are strained, sometimes they can't access the money that they put aside because their kids won't let them have it. And so I saw a situation several years ago where a doctor who had $10 million built up decided he really wanted to get into options trading, lost $10 million, and was in his late 60s trying to figure out how he was going to retire. He had 4 children, 2 of whom were estranged. He could not get money out of an irrevocable life insurance trust because the beneficiaries wouldn't dismantle the trust because they wanted to keep the money.
Yeah, strangely enough, right? Well, and the other component of the estate piece is, to your earlier example, they're putting money into this thing at 40 and their longevity could be 80, 85. Well, how many different times does the estate tax law change in 40 years, 45 years?
And you may or may not have any flexibility.
Yeah, well, and you may not need it, or you may need twice what you have. And so you're making a decision once that you've got to live with for the next 40 to 50 years. And the world is going to shift 10, 15, 20 times in that period.
Well,
And
and
so,
what happens if it turns out that one of the children is a criminal or an addict of some sort, and you have gifted
right,
this money irrevocably and they're going to get a giant check?
right.
Does that actually help your child? So the education piece of this, the flexibility piece of this,
Yep.
all of that is key. And that is something that has to be kept in mind. But your advisor should be working directly with your estate planning attorney in order to have minds collaborating on your behalf for the most creative and best solution for you.
Yep.
But for
All
a
right,
lot of people, saying that you need insurance for estate purposes, if your net worth isn't that high, it doesn't matter.
yeah, exactly. So let's walk through a couple, because I think there's a couple here that we can knock out in one conversation. The
Sure.
first is, after maxing out a 401k and a Roth IRA, isn't whole life the only tax sheltered option left? So we'll walk through that one. And then the other one is, well, let's just talk about that one first, because,
The
that
answer is
was it.
no.
The answer is no, right? And whole
You
life
have
is the
other
only way to
benefits.
pass money to heirs income tax free. And I feel like those two are kind of similar in that same sort of, what do we do for heirs? What do we do for tax sheltered options? And again, on both of those, it depends. There's a lot of different ways to go shelter income tax. It's not just 401k.
Don't use the word shelter. The IRS doesn't like that word.
This is true.
To minimize.
To minimize.
There you go.
There's a fine line between avoidance and evasion, where we want to stay on the
Yeah, there you
avoidance
go.
side of it, right? So yeah, so there's much different ways to go make more efficient tax use out of dollars. 401ks, IRA, Roth IRAs are one of the ones that most people talk about. Whole life is definitely one of them. And you mentioned one earlier, real estate.
Real estate.
And some other components there's a lot of different ways to go be efficient with your taxes.
Right.
Without
Well, and working
setting
with
it all
an
in a
estate
bucket.
planning attorney or a tax attorney in these situations are really important. I know, like, the attorney that I work with personally has an
Right.
LLM in tax, which is almost like a PhD in tax law.
Right.
And so all those things are factored in when we're having these types of conversations. And if your estate is big enough, life insurance can play a huge role in maintaining liquidity
Right.
and paying the eventual taxes and making sure that you've got long-term solvency and the ability to easily pass on to the next generation. I mean, part of a conversation that we had recently with a client was that their parents left a really big estate and the planning wasn't completely done and there wasn't enough liquidity, and it really put a lot of pressure on the children who were inheriting the money to try and figure out what they should do within a very short period of time.
Right.
And that's really what you're trying to avoid, is things already get weird and stressful when your parents pass away. The last thing you want is a bunch of infighting about how to make financial decisions because you've got a deadline to pay the IRS the estate planning taxes. So, I think that's part of what you're really trying to pay attention to here. But, just because life insurance does have the ability to be passed on income tax free, it doesn't mean it's the only way you can pass on assets income tax free. But I've never heard a responsible advisor say that.
No, that's not the only way. And it's some of the ways that you can sort of be efficient with taxes on the way up, right? During the accumulation phase. Yep, the Roths and the 401s, right? It's tax deferred along the way. Another way to go do that, especially for non-qualified dollars, is annuities have the ability to kind of build a 1099 shield along the way. Now, when you start, just like 401s, when you start pulling that money out, you're on the hook for tax, but it at least grows inside that bucket, inside that tax deferred bucket. So it kind of makes it more efficient along the way. Yeah, there's a number of different strategies, and each of them have their pros and cons of how to go get that done. So that's an important way to go do that. And then the other one that was sort of a cousin to that first question is, it's the only way to pass money to heirs income tax free. And I think we've beaten that one to death. I mean, you can do it through real estate and some of the trusts and some of the other components.
Even if you have money in the market, your heirs are going to get a step up in basis so that when they eventually sell them, they're only paying taxes on the growth that occurred after you passed away.
Yeah, during their custody.
So if you're inside of the estate tax exclusion, there's not a whole lot to worry about there. It's once you get outside of that you have the biggest issues.
Right. Exactly.
Not that
All
you
right.
have no issues inside of it, because certainly you do, but I think that's the part that people are, I think, more commonly looking at
Right.
when they're
Yeah.
making
But
things.
they're prescribing certain things that are applied to nearly everyone and saying, well, this is how you go do it, where
Right.
the people that have that issue or have that concern or is a very small portion of the population. All right. One of the other ones that I love is whole life insurance protects your money from creditors. Yes, again, it depends, and it's usually at a state level. So insurance is
Mhm.
regulated at a state level. So in some states, yes, in some states, no. And in other states, it's yes, but up to certain
But
amounts, right? It's not all the
yeah,
way.
so in Texas, where we are, life insurance has a complete exclusion from creditors and judgments and liens. And so what
Right.
that means is if you ever declared bankruptcy, the cash value inside of a life insurance policy and the eventual death benefit is not accessible.
Right.
It's accessible to you, but not to your creditors. And if you declare bankruptcy, it's an asset that you get to hold on to, similar to your homestead, right?
Right.
But just like you said, Eric, that's different in every single state. So some states will cap you at 250, some will cap you even lower, some will say none of this is protected. But that's one of those things you can actually just Google is life insurance protected in, and then type in your state.
Right.
And you should be able to, you can even get, I think, by Googling it, a state by state treatment of that. It's
Yeah.
pretty easy to find that information.
Yeah. And it's a neat little, again, it's my I buy the Swiss Army knife, not for the tweezers, but the tweezers come with it. It's
Mhm.
one of those things that, hey, it's part of the tax code. It's part of the laws. It's how it's set up. If it works for me in my state, then it's another feather in my cap that I get to go use on that side. But
And
it's not
specific
necessarily
to
why.
that, it's the state you live in when you purchase it. So if I live in Texas
Correct.
and I buy it in Texas, and then later I move to Oregon, I get the treatment from where I purchased it because it is issued in that state. So it is regulated by that state.
Right.
So just keep that in mind.
Right. Last two, life insurance lets you spend down your other assets, providing valuable flexibility in retirement. Yeah, go see
I
all of our
like that somebody
conversations.
thinks that's a myth. I need to flush that one out a little bit here,
Yeah,
because
but yes.
there's actual evidence and data that has been written about in white papers and publications whose names you would recognize that
Right.
actually proves that to be true. So it is fascinating to me that is a myth here.
That that's somehow a myth or not actually true. And it's just, man, do the research. All right, last
Right.
one. Banks own life insurance, so you should too. The other version of this is rich people own life insurance, so you should too. Banks, CEOs, insert some organization or some wealthy person, and if they do X, then you should do X. And at a fundamental level, again, maybe it depends, but I never got a job from a poor person. And if I'm trying to figure out how to go be rich or what institutions do and how they use their money, why not go look and see what they're doing? It may not apply to me, but at least I can get some concepts of how they use economics, how they keep money in motion. There's a great book, and I don't even know if it's in print anymore. A great book by a guy named Robert Castellone called Lifetime Economic Acceleration Process. It's called the LEAP book. And they talk about this, like the 4 rules of all financial institutions and wealthy people. And it would be stupid for me to read that and go, yeah, that seems like dumb advice. I'm just going to go see what my W-2 buddy down the hallway does, right? He seems like he can't put 2 dimes together, but he's doing a 401, and that's
might have good advice. Yeah.
right. So I think
I
it
actually
helps to look at that.
I have a hot take on this one. I think it may have something to do with the way I was raised and also my parenting style, which is very much, we don't care what Johnny's parents are doing. We're making our own decision.
Right.
So great that rich people do certain things, great that banks do certain things. And right. So
Fair, right.
So maybe a little different. So I'm gonna tone that back here just a little bit. But I think here's the thing. When you look at what banks are doing, they're looking at capital preserved over multiple lifetimes. And so there's multiple reasons that banks own life insurance. One, it's categorized as tier 1 assets. It's the safest capital. It actually counts towards the amount of times that they can like loan a dollar out because the
Right.
cash value has guarantees around it. So it's treated almost the same way that cash would be, but they get more growth on it. So
Right.
that right there would be one reason that banks are doing that. The second reason, and this goes to banks and CEOs for companies where life insurance is a provided benefit, oftentimes the way that is structured is that they get a lump sum at retirement or a payout over a lifetime. And then whenever they die, the death benefit shows up and goes back to the bank or the corporation.
Right.
So it is a way for the bank or the corporation to reimburse the stockholders essentially for the money that they paid out in order to attract and retain a particular executive.
Right.
And so when you think about that as a dynamic system involving multiple people and capital spanning generations, it makes a ton of sense. But if you're just looking at you and you're paying yourself, I mean, the death benefit is kind of nice because it goes to the next generation, but it all depends on how you're looking at things. And so just because someone rich does something doesn't mean it applies to you. Just because a financial institution does something doesn't mean it applies to you.
Exactly.
But to your point, Eric, it is ridiculous to just be like, I don't care what they do, right? You should at least understand what they're doing and why they're doing it so that you can make an educated decision about whether or not you want to do something similarly. But where this really kind of like chaps me is that I think right now on social media, right, you see a lot of, we're going to tell you the secrets of the rich. Here's what the rich don't want you to know that we know. Here's what the banks know that you don't know, right? And it's very like full of spin and this marketing stuff that makes you feel like if you don't click here, you're going to miss out and be poor for the rest of your life. And to me, it's very manipulative. And it's a way of trying to make people feel like if you don't do this, you're ridiculous, as opposed to giving people the benefit of the doubt here and saying like, here's a reason that a bank would do something like this. Here's how that same situation applies to you. And I get that from a sales perspective, one might be more powerful than the other. But I think for most of the people I work with, they want the information so that they can make a decision based on facts and evidence, as opposed to marketing and propaganda.
Right. Something about mimesis and wanting and Luke Burgess are all in that mimetic desire, right? But and I think it's important to understand that, right? And that I think you nailed it, that idea of what can I glean from this? What about this applies to me? What about this doesn't apply to me? I'm in the middle of you and I know the book or the person we're talking about. I'm in the middle of a book about John Boyd and the OODA loop. And I'm finding it fascinating, but I'm also finding that about 75% of the book has no bearing on my life whatsoever. It's just a cool story. But for the 25% that it does, I'm like, okay, I'm going to pull that in. I'll use it.
Can use it.
The rest of it, I'm going to throw out. But I think it's about being comfortable with where you are and knowing what your strategy looks like and how it fits. And I think that, as we wrap this up, this little 3-part series, I think that all applies. That's a blanket statement to really all, however many there have been, 27 different components here, is maybe, but do the research, understand where you are, what's applicable to you, what isn't applicable to you. So
Eric, can I ask you a question?
You always.
Is whole life insurance good or bad?
Yes, it is.
It depends.
It depends. Yes. Yeah, I mean, it's all situations are not the same, right? All situations and all people and all strategies are different.
If I just want to throw this out there for our audience, if you have heard a myth or an objection or have a question that we did not address about whole life insurance through this 3-part series, we would absolutely love to hear from you. You can shoot us a DM. If you're looking for me, you can find me at The Wealth Woman.
Yep.
Eric, can you do it?
Where can
they find you?
And you can find me at Economics with Eric, both on LinkedIn, Facebook, Instagram, all the rest of the stuff. So,
thank you so much for joining us.
Have a great one.